So you have this earnings call, right? Kodak's management gets on and paints this picture of a big strategic turnaround. But then you look at the market's reaction, and it's telling a completely different story. A story about risk, about a business in decline. And that's the huge disconnect we're going to tear apart today. And boom, this is what happens. The very next day, the stock just tanks. We're talking almost 20% wiped out. Now, this wasn't just a bad quarter. No, this was a total breakdown. It's like the company and its investors were speaking two different languages. And our whole job here today is to figure out why that happened. All right, so here's how we're going to break it all down. We'll start with the Q2 numbers, then get into the two competing stories, what management's saying versus what the market's hearing. After that, we'll look at what could fix this whole mess, and of course, we'll wrap it up with our take on the next call. Okay, first things first, let's just look at the raw numbers, the hard facts from Kodak's Q2 report. Okay, so what do these numbers actually tell us? Well, look at the earnings per share. It swung from a profit last year to a pretty big loss of 36 cents. Ouch. Revenue? It was basically flat, nothing to write home about. But here's the number that really jumps out, the real red flag, gross margin. It got squeezed by 3 whole percentage points. And when you've only got about 155 million bucks in the bank, that kind of pressure on your profitability, well, people are definitely going to notice. So you see those numbers and they don't look great, right? But if you listen to the earnings call, you'd think everything was fine. Management basically ignored the quarter and just kept hammering home their big long-term plan to fix the company's finances. Yeah, the CEO, Jim Continenza, was pretty much saying, hey, look, don't worry about these quarterly numbers. That's just noise. The real story is this huge financial fix-it job we're doing. That's what you should be focused on. So what is this big fix-it job? It all comes down to one thing, a pension reversion. It sounds complicated, but here's the gist. They have a pension plan with way more money in it than they need, so they're shutting it down to take back the extra cash. We're talking about $500 million in assets. And here's the key part, about $300 million of that is straight up cash that they plan to use to pay off a bunch of debt that's coming due. And they've laid out a very specific timeline for this. October, they sort out the retirees. November, they send out the checks. And then the grand finale, December. That's when all that extra cash is supposed to hit Kodak's books. I mean, you got to understand, this timeline, it's everything. It's the entire foundation for anyone who's optimistic about this stock. Now, it wasn't all about the pension plan. Management also talked up their growth story, specifically in advanced materials and chemicals. They've got this new pharma facility up and running in Rochester. It's even FDA-registered now. They're about to ship their first product. The whole idea is to build a new business that isn't tied to their old, declining ones, using the chemical expertise they're famous for. Okay, so the plan sounds pretty straightforward, right? Get cash, pay debt, grow new business. So why on earth did the stock get crushed by 20%? Well, it's because the market heard that story and basically said, yeah, that's nice, but what about the giant risks staring us in the face right now? And the single biggest risk was this little thing called a going concern disclosure that they buried in their official filing. Now, for any investor, seeing those two words is like a 5-alarm fire. It is a massive red flag. It's the accountants formally saying, look, we have serious doubts that this company can stay in business for the next year unless this very specific plan of theirs works out perfectly. So why now? What's the big deal? Well, it's because a bunch of their debt comes due in May of 2026. And all of a sudden, that's less than 12 months away. From an accounting perspective, that's a huge problem. Because that pension plan, to pay it all off, it's not a done deal yet. So according to the rules, you can't count on it. The market sees a ticking clock, but the money to defuse the bomb isn't actually in the bank yet. And what makes that ticking clock even louder is how the actual business is doing. Remember that 3-point drop in gross margin we talked about? That's a huge deal. Management can blame it on whatever they want, costs, volumes, but for investors, the timing is just awful. It looks like your core business is getting weaker at the exact same moment you're trying to pull off this incredibly tricky financial magic trick. And then there's the cash burn. I mean, they've burned through 46 million bucks just since the year started. Sure, it was a little better this quarter than last, but they're still burning cash. When you only have 155 million left and the accountants are already worried you might not make it, yeah, every single dollar flying out the door is put under a microscope. And this slide right here, This is the whole story in a nutshell. You've got management on one side telling this grand story about the future, the pension plan, the new pharma business, and then you have the market on the other side, and it's completely ignoring all that. It's just laser focused on the problems of today, the accounting warning, the weak profits, and the cash just draining away. So, how do you fix this? What could possibly bridge this giant canyon between what the company is saying and what the market believes? Well, there are a few key things coming up that everyone is going to be watching like a hawk. Number one, and this is the big one, is that pension plan. They absolutely have to execute it flawlessly between October and December. Any hiccup, any delay at all, and the market's worst fears will come true. Number two, we need to see proof of life from that pharma business. I'm talking about actual product going out the door in the fourth quarter. That's what will make the growth story feel real. And lastly, we need to watch for any moves they make with their debt or if they start selling new shares to raise cash. That'll tell us a lot about how confident they really are. All right, so that brings us to the final part of our breakdown, the next call. Here's where we put it all together and give you our official take. So look, the bull versus bear case here is actually pretty simple. The bulls are saying, just get the pension deal done. If they pull it off, that $300 million in cash changes everything. It fixes the balance sheet and everyone can start focusing on the new pharma business. But the bears are saying, not so fast. There's a ton of risk here. The main business is weak, and that going concern warning is going to act like a giant keep away sign for investors until that cash is physically in the bank. For us, right now, the scales are definitely tipping towards the bear case. That's why we're giving this an underperform rating. The risk that they mess up this pension plan is just too high to ignore, especially when the core business isn't doing so hot. Yes, there's a huge potential payoff if it all works, but man, the road to get there is full of potholes. So how might you trade this? Well, for more experienced investors, one play could be to look at long-dated puts. Think of a put option as a kind of insurance policy. It gives you the right to sell the stock at a certain price, protecting you if it drops. If you bought one that expires in early 2026, you'd be covered if this whole pension plan gets delayed or falls apart. Because if they miss that December deadline, that's when the going concern problem gets real, and the stock could take another major leg down. And of course, we have to say it, remember, this is all for informational purposes. This is not financial advice. So we'll leave you with this one question, because it really gets to the heart of the whole Kodak story. The company is in a flat-out race against the clock. So can their financial magic trick work fast enough to save them before their main business sinks? The next 6 months are going to give us the answer.